Omi PLC and Rua PLC Limited had acquired Omi PLC and Rua Limited had acquired their holding in Millie Limited on the same date as part of an attempt to mask the true ownership on Millie Limited. Omi PLC acquired 40% and Rua Limited acquired 25% of the ordinary share capital of Millie Limited on December 1, 2018. The retained earnings of Millie Limited that day were 200 million naira, and those of Rua Limited were 600 million naira. There was no revaluation surplus in the books of Millie Limited on December 1, 2018. The fair value of the net assets of Millie Limited at December 2018 were not materially different from their carrying amount. 3. The group operates in an information technology sector and has incurred a significant amount of expenditure on the development of various internet products. Those products were formally written off to statement of profit or loss as incurred, but then reinstated when the related internet products were into commercial use brought into commercial use. The reinstated costs are shown as development inventories. The costs do not meet the criteria in IAS 38. Intangible assets for classification as intangible, and it is unlikely that the net cash inflows from this product will be in excess of the development cost. In the current year, Rua Limited has included 80 million naira of these costs in inventory, of which 20 million relate to expenditure on a product written off in period prior to December 1, 2017. Commercial sales of this product has commenced during the current period. The accountant now wishes to ensure that the financial statements comply with IFRS as regards this matter. 4. Rua Limited had purchased a significant amount of new internet equipment during the year. The cost before trade discount of this equipment was 200 million. The trade discount of 24 million was taken to the income statement. Depreciation is charged on straight line basis over 6 years period. 5. The policy of the group is to stay the property, plant and equipment at depreciated historical cost. The group changed from the revaluation model to the cost model under IAS 16 property, plant and equipment in the year ended November 30th, 2020, and restated all its assets to historical cost in that year, except for the property, plant and equipment of Millie Limited, which had been revalued by the director of Millie Limited on December 1, 2019. The value were incorporated in the financial records, creating revaluation surplus of 280 million. The property, plant and equipment of Millie Limited were originally purchased on December 2018 at a cost of 1,200 million. 1,200,000. The assets are depreciated over 6 years on straight line basis. The group does not make an annual transfer from revaluation reserve to retained earnings in respect of the excess depreciation charge on the revalued property, plant and equipment. There were no additions or disposal of the property, plant and equipment of Millie Limited for the 2 years ended November 30th, 2020. 6. It is the group's policy to value non-controlling interest at acquisition at their proportionate share of subsidiary identifiable net assets. 7. During the year, the directors of Umi PLC decided to establish a defined benefit pension scheme for employees of the parent company and contributed cash to it to the tune of 400 million naira. The following details relate to the scheme as at November 30th, 2020. All figures are not correct. The only entry in the financial statement made to date is in respect of cash contribution, which has been included in OMI PLC trade receivables. The directors have been uncertain as to how to deal with above pension scheme in the consolidated financial statement because of the significance of the potential increase in the charge in the change to the statement of profit or loss relating to the pension scheme. They wish to recognize immediately any actuarial gain in statement of profit or loss required. Prepare consolidated statement of financial position of OMI Group for the year ended 30th November 2020 in accordance with relevant IFRS. That's the answer. Hello, sir.
I'm with you guys. I'm with you. Um, so um, okay, so we have information about Omiruwa and Mili, and just like we have it, this is a case of mixed subsidiary because Omi acquired Ruwa and Ruwa acquired Mili, of which Omi also acquired a percentage in Mili, and that gave them control. So that makes Mili a sub-subsidiary to Omi. And just like we said, we'll deal with it. We'll have what? Number one is to first draw the group structure as we have it. So we have the draft statement of financial position. Okay. So in drawing the group structure, what do we have? We have Omi PLC. Omi PLC acquiring Ruwa PLC, and what they acquired there is 80%, 80%, and with this NCI in Ruwa will be 20%. Then Omi and Ruwa acquired holding in Mili Limited on the same date. Omi acquired 40%, while Ruwa acquired 25%. So Ruwa in Mili is 25, while Omi in Mili, sorry, let me do it this way. So that I can show the D shape that we make reference to. D shaped. Omi in Mili is how much? 40%. So effective interest in Mili is, can that person mute their mic? Thank you. Equals to 40% of, sorry, 40%, which is the direct investment they have in Mili, plus what? 25% times 80%. You know, they hold 80% of whatever Ruwa holds. So 25%, 80% of that 25% will be their whole. 80% of that 25% will be theirs. So if 80% of that 25% is their own, that means the whole 20% plus the 40%, that makes it a total of 60% they hold in milli. And NCI in milli will be what? 40%. The date of acquisition for RUA, date of acquisition for milli, and date of consolidation will be what? For date of acquisition for RUA, we have that to be what? They acquired them on December 1, 2017. For date of acquisition for milli, they acquired that on December 1, 2018. And we are consolidating for all of it as at November 30, 2020.
Yes, sir.
Any question?
No, sir. Let's move on. Let's progress, sir.
Okay, so as we were saying, having done the group structure, we can now proceed with one after the other the additional information we have. So please, I need our maximum attention. So they've given us the retained earnings on the date of acquisition. They've told us that the fair value of the net asset of RUA was 2,840 million. That's 2 billion plus. No problem. They now told us that any fair value adjustment related to net current asset, and this net current asset has been realized by November 30, 2020. There has been no new issue of shares in the group since the current group structure was created. Now look at this. First thing first, the usual thing we are used to is that where we have a fair valuation at the date of acquisition of a subsidiary, they will tell us the fair value surplus is relating to a non-current asset, maybe a property, a plant and machinery and the likes. But in this case, they told us is related to what? A net current asset. A current asset, which has been what? Realized. You know, in the previous one we are used to, the fair value we have on the date of acquisition will still be existing at the date of consolidation because the asset is yet to be realized. They haven't sold the asset, so the fair value is still there. But in this case, they told us it's relating to a current asset and it has been realized. So when we get to the net asset summary, we'll look at how we'll deal with this. The next one, they told us Omi and RUA PLC had acquired their holdings in milli on the same date. Okay, they told us the retained earnings of the day were this, and that of RUA, we don't need that of RUA on that day because the date of acquisition for RUA is that December 1, 2017, not December 1, 2018. There was no revaluation surplus in the books of milli, and the fair value were not materially different. So that means we don't have fair value adjustment in that. Number next, they said the group operates in an information technology sector and has incurred a significant amount of expenditure on the development of various internet products. Those costs were formally written off to statements of profit or loss as incurred, but then reinstated when the related internet products were brought into commercial use. Now, this is wrong. This is wrong, meaning what? Because it is wrong because according to IS 38, if we have research and development costs, research costs are to be expensed. Research costs are to be expensed over the period in which the research cost is incurred. Development costs are also to be expensed till it meets the capitalization criteria. which are like there must be the company must be able to bring the asset to a condition of use or sale. They must have technical feasibility of completing the development of the product, amongst other things. Now, the standard now makes it clear that before they meet the criteria, the capitalization criteria, if you have expensed any development cost, you cannot reinstate it. Anyone that has been expensed before they meet the criteria is gone. Is the one that they haven't met that we have to what? That we have to put when we that we have to capitalize. So that means them reinstating the cost is entirely wrong. Now, they now even tell us that these costs do not meet such criteria in IAS 38. So why should they even reclassify it? And it is unlikely that the net cash inflow from these products will be in excess of the development cost. In the current year, Rua Limited has included 80 million of this cost in inventory, of which 20 million relates to expenditure on a product written off in periods prior to December 1, 2017. Commercial sales of this product has commenced during the current period. The accountant now wishes to ensure that the financial statement comply with IFRS as regards this matter. So they are telling us that they want this thing to be in line with IAS 38. So this 80 million, this inventory of 80 million that they said they included in this, they said they included it in the cost of inventory. What do we need to do to it? It is wrong for them to include it as inventory. So we need to take it out. We need to take it out. And we'll say for development costs, wrongly, development cost reinstated. We need to take it out again. Development cost reinstated. It will be what? 80 million. And for that 80 million, what do we do? They said they've included it in their inventory. What do? We'll debit it to where? Retained earnings of who? Of Rua Limited, and credit it to where? And credit it to inventory. Why are we taking it to retained earnings of Rua Limited? You know, when they were expensing it initially, I mean, when they first incurred the cost, when they were expensing it, the double entry they would have passed would have been to debit retained earnings and credit the bank where they are making the payment. Now, when they now want to reinstate it, the double entry they would have passed is just like reverse of that. They will now what? Debit it as an asset in the inventory and credit it to their retained earnings, an additional income. But now that we want to cancel it, we just need to do reverse of that last entry they passed, which is debit retained earnings and credit inventory. Now, this 20 million, they now told us it has been written off a product. They told us it relates to expenditure on a product written off in period prior to December 1, 2017. Now, how does this affect us? Because that figure has been written off prior to 2017. You remember 2017 was the date of acquisition. If that product were not written, if that product were capitalized before 2017, that means their retained earnings at the date of acquisition will not be right, because it should have included what they should have expensed, but they are decapitalized. But because that figure was written off before 2017 and it was only brought back in the current year, then we are good to go with just this one entry we are doing. But it, had it been it is had it been it is what's it called? Had it been it is it wasn't it was capitalized then we'll have to cancel it out. Do we understand? Do we understand?
Yes, sir.
Okay. Number next, we have Hua Limited had purchased a significant amount of new internet equipment during the year. They've purchased what? They've purchased a new internet equipment during the year. The cost before trade discount of this equipment was 200 million. Trade discount of 24 million was taken to the income statement. Depreciation is charged on straight line basis over a 6-year period. Now, the rule is that what? Trade discount shouldn't even have come into our SOPL at all. We want to acquire an asset and the asset cost is 200 million. We are giving a trade discount of 24 million. You know, trade discount is a bulk discount or a quantity discount. Regardless of when you pay, you will enjoy the discount. So trade discount doesn't come into our books. What they should have just recognized in their books is the 176 million outrightly. But now that they told us they now took this 24 million into their income statement, we need to correct it. Trade discount capital, trade discounts. What will be the figure? 24 million. And how do we correct it? We'll debit it to retained earnings, because for them to recognize it in their income statement, that means they would have taken it to be an income. Then we'll now credit it to where? They said they recognize it in their income statement. So why they credited it to income, they would have debited it to the PPE. So we are crediting PPE so as to take it out from there. Now, because they recognize the asset at the whole 200 million instead of them to recognize it as 176 million. Now, having done this, it will now create what we call over depreciation, because they will be depreciating over depreciating, because if they were, as they were depreciating the asset at that 200 million, it will give rise to them it will give rise to them charging more than the amount they were supposed to charge as depreciation. So what do? We'll now say over depreciation. And what will be the over depreciation? Since they overstayed the asset by 24 million, they would have also over depreciated the asset by the 24 million. So it will just be 24 million divided by the 6 years, because they told us 6 years is the asset useful life. Then when did they buy the asset? They said they bought it during the year. They now said the policy of the group is to state property, plant, and equipment at depreciated historical cost. The group changed from evaluation model to cost model under IAS 16 in the year ended and restated all of its assets. I'm coming, no? Because I want to know if they charge full year depreciation. Okay. They did not tell us anything about that. So if it was during the year, then that means it was just 1 year depreciation they have charged. It was just 1 year depreciation they have charged. So times 1 will give us what? Figure, please.
Four million.
What do you call it? 4 million, Abby?
Yes, 4 million.
Okay. One minute. 4 million. So, and what will be the double entry for that 4 million? We'll now debit that to our PPE and we'll credit it to the retained earnings of RUA. So, note 5, we'll have what? Note 5 will have, they said the policy of the group is to state the property, policy of the group is to state the PPE at depreciated historical cost. The group changed from the evaluation model to cost model under IAS 16, and in the year ended November 30, 2020, and restated all its assets to historical cost in that year, except for property, plant, and equipment of Millie Limited, which had been revalued by the directors of Millie on December 1, 2019. The value were incorporated in the financial records, creating a revaluation surplus of 280 million. The PPE of Millie were originally purchased on December 2018 at a cost of 1,200 million. The assets are depreciated over 6 years on a straight line basis. The group does not make annual transfer from the revaluation reserve to retained earnings in respect of excess depreciation charge on the revalued property, plant, and equipment. There were no additions or disposal of the property, plant, and equipment of Millie Limited for the 2 years ended November 30, 2020. Okay, so what are they saying with all of this? They were using evaluation model to recognize their assets before. You know, under IAS 16, we have two models, cost model and evaluation model. Cost model is for us to, cost model we do cost minus accumulated depreciation minus impairment. But under evaluation model, we do revalued amount minus subsequent depreciation. So we have all of this. Now, others have already changed their home from evaluation model to cost model, but Millie is here to do same. Now, you know, the change from evaluation model to cost model in line with IAS 8 is a change in policy, and we should do what? We should apply a retrospective approach. We should apply a retrospective approach. That is, we go as far back as practicable to say, oh, this new model will apply it as if that's what we have been using since. So that means for Millie, they purchased the asset at 1,200 million and they are depreciating it over 6 years from December 2018. So this revaluation surplus they have recognized on the asset, because they are no longer using revaluation surplus, this revaluation model, because they are no longer using evaluation model, this evaluation surplus shouldn't exist again. It shouldn't exist again. So what do? We need to cancel out this revaluation surplus. We need to cancel out this revaluation surplus. So we'll have so let's first say let's calculate calculation of carrying amounts. Or let me just, since I have not been putting it in, let's just say carrying amount of the asset as at the end of the year. Carrying amounts as at 30 November 2020 will be what? Cost of the assets 1,200, then less, so we'll say less depreciation. Since they are depreciating it over a 6-year period, 1,200 divided by 6 will be what? That will give us 200. So at the end of year 1, it should be, the asset value should be 1,000. But they told us that, you know, they bought the assets in 2018. So at the beginning of 2019, I mean December 1, 2019, the asset should be 1 million. But they told us as at that day, it had a revaluation surplus of 280. So if we say revaluation surplus 280, That will bring the asset value to what? 1,280. Then the depreciation they will now charge for year 2019 to the year ended 2020 will now be what? Will be depreciation. Depreciation will now be 1,280 divided by 5 years. And that will be what? 1,280 divided by 5 years is what?
256.
Huh? 256.
256.
So if we take out the 256, what do we have? 1024. So if you go to their books to check what the non-current asset is, you can see this is the 1024 here. But we don't want to carry it at 1024 again. If we are to use cost model for it, this is carrying amounts using revaluation model. If we are to use cost model for the same asset, cost model will have what? The cost is what? 1,200 less accumulated depreciation. Accumulated depreciation will be what? $1,200 divided by 6 years multiplied by 2. That's 20. You know, they bought it December 2018. The first year will end 2019, the second year 2020. That should be what? 400. And that should be what? That should be the difference will be what?
800.
800.
800.
So the asset value that is showing 1024 in the books, we want to bring it down to 800. So what do? We will say what? We will say debit PPE, debit revaluation surplus. You know, the whole 280 is still there because they told us they don't take from revaluation surplus to retained earnings every year in order to recognize the excess depreciation. So the old 280 will still be in our revaluation surplus 280. Then what do we now do? We'll credit PPE with the difference between the 800 and 1024, which is 224, and credit where? And credit SOPL with how much? With the difference, which is what? How much? 56. Now I will explain each and every figure again. The 280 is the revaluation surplus we have on the asset, which we don't want to keep again because we no longer want to use the valuation surplus for the asset. That's why we are debiting that. Don't forget, the valuation surplus is an equity account. That means the initial entry would have been a credit. We are crediting PP with 224 so as to bring down the value from 1024 to 800, which is what it should be under cost model. Then if you look at it, in year 2019, we charge 200 as depreciation. But in year 2020, we charge 256 as depreciation. That is because the excess of 56 was as a result of the revaluation surplus. Now that we are cancelling the revaluation surplus, since this 256 was charged as an expense to the SOPL, we should take it back to the SOPL. So it will affect the retained earnings of Millie. Retained earnings of Millie. I'm sorry. Sorry. Retained earnings of Millie. So that is that. That is that. So what do we have? Have okay. So we have what? Note 6. Note 6, we are told that what? The group policy is to fair value NCI at acquisition at a proportionate share, no problem. During the year, the directors of OMI PLC decided to establish a defined benefit pension scheme for employees of the parent company and contributed cash to it to the tune of 400 million. The following details relate to the scheme as at November 30, 2020. What do we have? We have all of this. So they said the only entry in the financial statement made to date is in respect of cash contribution, which has been included in OMI's PLC trade receivable. The directors have been uncertain as to how to deal with the above pension scheme in the consolidated financial statement because of the potential increase in the change to the SOPL relating to the pension scheme. They wish to recognize immediately any actuarial gain in the statement of profit or loss. Actuarial gain or loss is to be recognized in the other comprehensive income, not statement of profit or loss. It's to be recognized in other comprehensive income, not statement of profit or loss. So we'll say, first thing first, recognizing the cash contribution in the trade receivables is very wrong. Contribution for defined benefit plan assets. Abi? Defined benefit plan assets. That will give us what? They contributed 400 million. And that 400 million, they said it was recognized in receivables before. We'll go and credit it to receivables so as to remove it from there. And debit was the defined benefit plan assets. The defined benefit plan assets. That is where it should be. Now, for other things, that's not the only thing they should recognize. We'll now have what? The defined benefit plan assets. What we should have add on it should be, since they are just creating it this year, we don't have opening balance. But we have what? We have contribution. Contribution was 400 million. Then, okay, they give us interest. Okay, expected return. Return on assets. Return on assets. Return on the plan assets is how much? 40. So if that is all, we have that to be what? 440. 440. Then fair value of plan assets is how much? 500. So that will give us the actuarial gain of 60. Actuarial gain of 60. While for the defined benefit plan obligation, we have what? Current service cost. 440. Interest cost. 80. And that will give us a total of what? 520. Present value of plan obligation. 520. So that means actuarial gain or loss will be nil. Actuarial gain or loss will be nil. So if that's the case, then what we should now have is for the contribution, they said they've already recorded that, which we have passed for double entry to change it, to correct it. For the return on plan assets, they should debit the retained earnings of OMI PLC because they hold it Sorry, they should credit the defined benefit plan assets, defined benefit plan assets, DBPA, and credit the retained earnings of OMI because it's an additional gain to them. Then for the actuarial gain, they will debit the defined benefit plan assets and credit it to other equity or equity reserve. That's where it should be. Equity reserve. So for the current service cost, they are supposed to debit that to the retained earnings of OMI PLC and credit it to where? The defined benefit plan obligation. For the interest cost, they are supposed to debit it to the retained earnings of OMI also through finance cost and credit it to defined benefit plan obligation. And that is all we have. Do we understand? Do we understand?
I don't understand this part though.
Hello?
I don't
Hello,
You don't
sir.
understand.
understand which one?
The other part, this DBPO, is that
Can you speak
defined
up? I can barely hear you.
I said the
Hello?
second part. Can you hear me now? Hello?
A bit better.
I'm asking that the other part, this DBPO, the defined benefits
Yes.
plan obligation. I don't understand that part.
The DBPO, yes. Defined benefits. Have you guys done IS 19?
No, we have not done it.
Oh, that's why it is looking somehow tricky. So when we have defined benefit plan asset and defined benefit plan obligation, uh, we do what? We are to so the defined benefit plan obligation is just like so we are saying they want to reward their staff at the when they want to retire from the business. So the business wants to maybe they have set a certain amount that okay, we want to give them maybe 100 million we want to give this staff 100 million when he's leaving. So what they now do is they have an obligation of 100 million, but the 100 million obligation will only be after maybe when maybe they would have set a target like okay, when the employee works for 3 years, that's when they will be entitled to the 100 million. So what will now happen? What will happen is as the employee is working, the employee is already making, they will be recognizing what do they have as liability to that employee. So if it is 100 million now, they will discount it to today's term and divide it by 3 and say okay, for year 1 this is what we are, this is what for the work the person did this year, this is what we are obliged to pay based on if he is leaving. Year 2, year 3, but every year they discounted it. They will be calculating interest on it. That's one. So in order to meet that obligation, they also create an asset. So they might buy maybe shares in one company or buy a bond or this something that can be yielding benefits to benefit that they will be able to use that liability when it arises. Are you getting it? So
I
that's why
understand.
in the plan assets, we recognize their contribution and the returns, that is the interest income they would have made on that contribution. While for the defined benefit plan obligation, we recognize the current service cost, that is the value of obligation that has arisen as a result of the work those employee has done for that year. Then we added the interest element on it to that figure to get the this thing. So they will also engage the services of an actuarist to value their assets and say, okay, this is the fair value of the plan of the asset you have now. and what is the present value of the obligation we have. Whatever difference that is now between the actuarial figure and their own book value, we refer to it as actuarial gain or loss. So as you can see, for the asset, the fair value is 500, but the book value is 440. That means there is an actuarial gain of 60. But why we take it to other equity, not retained earnings, is because it's fluctuates. Next year now it can change again. So we don't want it to be impacting our profit when we are not certain yet. Do we understand?
Yes, sir. Thank you.
Is it clear now?
Yes. Yes, sir.
Naza, why are you fighting with your phone? Move closer to it now.
I'm making use of earpiece. Maybe
Or
that's
are
why.
you scared? I was wondering, maybe you are scared someone will collect it from you. Because you are here to fight for you. Nobody dares collect your phone from you.
Yes, sir.
Hmm? So is it clear now? Can we proceed with the next thing?
Yes, sir. It's clear. Thank you.
Eh?
Yes, sir. Yes, sir.
Okay, so that is that. We will now have net asset summary. Net asset summary, which is our usual this thing. Net asset summary. So in our net asset summary, we will have what? We are doing for the two entity. We are doing for Goa and Millie. We will have DOA, DOC, PAE, DOA, DOC, PAE. So what do we have under our assets? Under our equity, we have share capital, 2,000. Come online. 2,000 nil. 800, 800 nil. Then we have what? Share premium, 400, 400. They said their capital structure hasn't changed. 200, 200 nil. Then what else do we have? Revaluation reserve. The revaluation reserve is what we just take care of now. So we'll have revaluation reserve. We don't have anything here, but we have 280 here, which we don't have on the date of consolidation again. So that will be negative 280. Then we have what? Retained earnings. Retained earnings. On the date of consolidation, it is 800 and 240. But on the date of acquisition, for Gua PLC, they said they were acquired when their retained earnings was 400. That means post-acquisition should be 400. Then for Millie, they said they were acquired when their retained earnings was 200. So that means the post-acquisition earnings will be 40. So what do we have? We move to other information. We were told that, don't forget, in note 1, we were told that the fair value adjustment, the net assets on the date of acquisition was 2,840. And if you had all of this is 2,800. So what do we have? Fair value adjustments. Surplus 40 in year one. At the date of acquisition, sorry, is 40 because 2,840 minus 28 will be 40. But they told us that it has already been realized. It has been realized. If they say it has been realized, that means it has been sold. They've earned that money. So it shouldn't be there at the date of consolidation again. Shouldn't be there at the date of consolidation again. So that will make this to be 40. But they did not tell us any fair value difference for this. Then the next thing they told us was that this intangible asset, what did we say we'll do to it? We say for the intangible assets, we said we'll debit it to the retained earnings of GUA, 80 million. So if it's affecting the retained earnings, that means it's affecting the so we'll have the development costs. It doesn't exist on the date of acquisition, but we have it on the date of consolidation, 80. So that will be 80 because it's a debit. That's why we are putting it in brackets. Then for the trade discount, we have what? For the trade discount, we have what?
Yes, 24.
For the trade discount,
24 million.
okay. Okay. So what do we have next? We'll have so for this trade discount, we have trade discounts 24 million. Trade discounts 24 million. We are debiting it to retained earnings. So then over depreciation of 4 million, over depreciation, then what else do we have? The so this carrying amount of milli, I think we've already treated that, have we? So we have the revaluation surplus we cancel give rise to charging an excess of 56 million to retained earnings. So I'm coming. So for their own over depreciation, we have 56 million. So we have this. So with this, what do we have as the net as the total for each column?
So where is the 56 million coming from?
This one, ma. Due to the revaluation translation, it has made us to overcharge depreciation by this thing. It has made us overcharge depreciation by 56 million. Is it clear?
Okay, okay.
Hello?
Yes, sir.
Okay. So that is that.
So I just the net asset summation and the figures.
Hmm?
I said your screen. I cannot see the figures on the net asset summary.
Oh, sorry.
That's we have 2,820 for date of acquisition for Lua.
2,840, Abby.
2,820.
Eh?
2,820.
820K. Check the
Yes.
date of acquisition very well. Oh. This is 2,400, 440. That should be 2,840.
And plus the over depreciation. Okay, 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 okay. I made mistake. Sorry.
This should be 3092. Abby? For it. Why this will be what? Oh. Sorry, oh, for this one, the valuation surplus was no longer existing at the yeah, that's why we have to make it 0. So okay. So what do we have?
1296.
Yeah, because they make him like you.
Two nine six.
This is one
Then
two
PA is
this.
184.
Then this is to give us what?
184 negative.
184 negative, Abby.
Yes.
So we have what? The next
Sir,
thing we should be calculating should be goodwill.
sir, I'm getting 3,100 for the date of consolidation, oh, for Rua.
3,100.
Yes.
It's 1296.
Oh yeah, you are right. 300.
Then the PA is 60.
60. So what do we have? Rua and the purchase consideration slash the direct investment for Rua and for Millie. The purchase consideration for Rua is how much? 2560. The direct investment in Millie was 640. Then indirect investment, that will be only in Millie. They will take what? 80% of how much? Of the 400. And that will give us how much?
320.
320. NCI at proportionate share. So for it to be 20%, 20%, 2,840. Why for Millie to be what? 40% of 1,480. Then with less fair value of net assets.
568 for Rua. 592.
568.
Yes. Then 592.
59.
2.
So this will be 2,840. and this will be 1,480. So what do we have as the goodwill? So I don't think they told us anything about impairment in the question at all. There was nothing relating to impairment of goodwill.
There's no
So
impairment.
what do we have?
288 for Rua.
Hmm?
288.
288.
Yes.
Uh-huh.
72.
272.
No, 72. 72. 72.
72. Okay, so we can go to note 9. And note 9 will be for us to calculate NCI. And NCI will just be value at acquisition, 568 for this, 592 for this. Then share of post-acquisition earnings. We will have for profits, the profit is 260 here. They will share 20% of 260. 20% of 260. Why this one will take 40% of 96. Abi? No, these two are affecting profit. That's 96. Is this one that is having negative 280. So evaluation surplus, this one has nothing, but this one will take 40% of negative 280. Figure
52 for Rua. Then 38.
52 here. This will be 38.4. 112 negative.
112.
So aside that, I don't think we have any other thing, but we'll less purchase consideration in milli from these people, which will be 20% of the how much did they pay to acquire it. They paid 400 to acquire milli, so 20% of that will be 80. So NCI should be how much?
540.
545.
540. 540. Then 518.4.
Having calculated the NCI, we can now go to the earnings. So for consolidated retained earnings, we have for consolidated retained earnings, we'll have what? We'll have Omi's retained earnings, which will be 2,500. Then we bring their share of post-acquisition earnings. We'll say for ROA, they will share 20% of 400, no, 260. 20% of two, they will share 80%, sorry. 80% of 260. And for Millie, ideally, for Millie, we are supposed to split the retained earnings and the profit itself. But because OMI doesn't have any retained, any revaluation reserve, then even if we split it, it will now make the revaluation reserve to be negative, which is wrong. That means we should have just charged it to the SOP. That's why we'll just share the full value here. 60% of how much? Negative 184. Negative 184. Or we can do it separately so that it can be better understood. We'll say profits 60% of 96, then revaluation surplus 60% of negative 280, and that will give us how much?
ROA is 208.
208.
57.6.
57.6.
168 negative.
What do you say? 168, but that should be a negative figure. So having taken those ones into consideration, we come back to our adjustments. So number one, number two has been treated. 2, 3, 4 has been treated. Number 5 has been treated. Number 6 is the one we are here to treat. We have return on assets. Return on assets affecting retained earnings. Sorry, can that person mute their mic? Return on plan assets. 40. Then what else do we have? Return on plan. So finance, current service cost and interest cost. Current service cost and interest cost. Current service cost 440. Interest 80. Aside those, do we have any other thing? I don't think so. So what do we have here? What do we have?
Two thousand 117.6.
2117.6. So that is that. Then I don't think we have any other thing left. We can go ahead to consolidate. We can go ahead to consolidate. So we'll have what? Consolidated. Let me just put it on the new sheet. No problem. We can just continue. Consolidated statement of financial position. As at 30 November. Kí ló ṣẹlẹ̀? So we have naira in million, naira in million. So we'll have non-current assets. What's our non-current assets? PPE. What's the PPE? 4,920 plus 2020 plus 1024. Then what are the adjustments we have for PPE? Number one, we have what? We have what? We have credit PPE with 24 million of trade discount. So we'll say minus 24. Then debit it with over depreciation of 4 million. So plus 4. We have debit it with what? Credit PPE with 224. 224. So we'll say minus 224. I think that is all we have on PPE. So what do we have in summation? Then after that, we'll have the defined benefit assets,
7,720.
which is fair value is 520. 75.
7,720.
7720.
77 7720. Okay. So after defined benefits plan assets, we have goodwill. And the goodwill is how much? 288 plus 72. Can that person make money? That's 360. Aside that, I don't think we have any other current asset figure. That will give us how much? 8,600. Then current assets, we have what? Inventories. 1,200 plus 540 plus 260. So the next, we said that inventory should be credited with that 80 million. So we'll say minus 80. I don't think we have any other thing. Trade receivables.
1920.
1920. Trade receivables. We have 960 plus 420 plus 196. But don't forget the 400 million for contribution was put there before that. We say they should deduct this additional information. 6, we are crediting what? Receivables without 400 million. So what do we have? Cash and cash equivalents. What do you say?
11.
176.
1
76.
me going 117 what?
1176. 1176.
360 plus 200 plus 320. There was no cash in transit or any cash adjustment here. So what will that give us in total?
880.
880.
Yes.
What's the summation?
3976. 3976.
397. So what's the summation?
12,576.
12,576. Okay. Share capital is 6,000. Share premium is 1,200. We don't have revaluation surplus, but consolidated retained earnings is 2117.6. 2117.6. Then other equity, which is the actuarial gain. Actuarial gain 60. So what is the total for our shareholders fund before we bring NCI?
9377.6.
4580. Omi ìgbó ẹ o.
9377.6.
9377.6. So what's our
Current liability.
NCI? Non-current liability, we have 540.
1058.
1058.4. 540 plus 100 plus 80, and that will give us what? 720, Abby.
Yes.
Then define benefit plan obligation. Hey, you have made a mistake. Oh. Define benefit plan obligation. Plan obligation is one of 520. Plan asset should be 500. So that means I need to make a correction here. This should be 500. This should be 580. That means this should be 556. Let me confirm the figure. But the defined benefits plan obligation should be 520. Then current liabilities, we have that to be 400 plus 280 plus 200. And I don't think we have any adjustment to current liabilities. What do we have?
Twelve five five six.
So that is that on that. Do we understand?
Yes, sir. But sir, what is the meaning of that actuarial gain?
So what do you say?
I said the actuarial gain. I just want to
Yes.
understand the meaning of that word.
So When we have defined benefit plan obligation and defined benefit plan assets, we have to engage the service of an actuarist to give us. So actuarial an actuarial scientist is just like an insurer or a valuer that will look at that will do their own calculation to say, okay, this asset we have, what is the future value? What is the fair value of it? This obligation we have, what is the present value of it? They do their workings. They have their way of doing their workings. They give us the value.
But
Now
okay, sir.
that value is like the intrinsic. That value is like the value we can get. If we are to settle that obligation as at today, the present value is what we will be paying. If we are to dispose of the asset today, the fair value is what we'll be getting from it. Are you getting it?
Yes, sir. Yes, sir.
So
Yes, sir.
when we now do the actuarial valuation, we now the difference between the actuarial valuation and whatever we have in our books, that's what we call the actuarial gain or loss. And that
Okay.
actuarial gain or loss, because it will change. Next year now, we'll do another one. It will change again. That's why we don't take it to our SOP. We take it to other comprehensive income.
Cool.
Do you understand?
Okay, sir. Thank you, sir.
When we are now done with the plan, maybe we've now paid everybody. We now have any actual gain. That's the one we will now take to our SOPL. Or if we have actual loss, that's the one we will now charge to our SOPL. Is it clear?
Thank you, sir. It's understood.
Thank you very much. So we'll be meeting in the next class to discuss step acquisition.
Okay.
To discuss what, sir?
Step acquisition.
Okay.
Okay.
All right. Have a good night
Thank
rest.
thank you, sir. Good night.
Thank you, sir.